What we found was, like, with the emergence of CDR, with the emergence of some open banking, the Deposit Takers Act, a lot of finance regulations are about to be changing. That's going to really explode innovation. So Marty and I saw this sort of coming, and we were sort of yelling out to anyone who will listen, hey, New Zealand needs a fintech fund, New Zealand needs a fintech focused fund. We realized no one was really hearing us, and we actually sat down one day and said, just have to be us. Because what we realized is, once a fintech had shown product market fit, once a fintech had hit $1 million ARR, the bigger VC funds in New Zealand and Australia would invest in them no problem. But having the faith or having the confidence pre-revenue, hey, I've got an idea, or, I'm halfway to building my MVP. A lot of the traditional VC market in New Zealand probably didn't really understand with confidence around how that could play out and how big that could be. So March 2024, Marty and I put together the New Zealand Fintech Fund.
Hello and welcome to another episode of Ways to Wealth. Today I am joined by Mike Burke. Mike, you're from NZ Fintech Fund, and we're back to talk about a day in the life of a boutique VC, I guess, managing partner, general partner of a specified VC fund.
That's right.
So, I think what we should start off with is to kind of set the scene a little bit.
Sure.
And I guess talk about what is a boutique fund, or how do you see a boutique fund, I guess, from a actual business owner perspective and an operator perspective, and then we'll talk about maybe the role of a boutique fund.
Sure. So we classify a boutique, I think one of the easiest ways to look at it is look at what the macro funds are as, sort of a traditional major Kiwi venture capital fund. So I'm thinking, Icehouse Ventures, Movac, Blackbird, some of these really big, what I'd call like general funds, general VC funds. So they typically raise anywhere from $20 to $100 million. They'll invest in multiple verticals or business classes from anywhere, and they might specialize in some certain areas, or they might go through different trends, and they'll do some early stage or Series A, Series B, Series C stuff. Yeah. They'll have their own investment thesis and some promises that they've made to investors, and they've got to live on that. Where I look at boutique is where it's quite specific, and how. And especially with the New Zealand Fintech Fund, so we have a very specific investment thesis, what we look for, what we like. Our fund size is much smaller, so we will raise anywhere between 2 to 6 million. So New Zealand Fintech Fund 1 is a $2.5 million fund, and we're looking at opening Fund 2 in the end of the first quarter next year. So. And there's quite a few of us growing. There's definitely an emerging market of venture funds in New Zealand that are a bit boutique. But we would be one of the smaller ones, and we are very specific. But you've got some others that will do deep tech. You'll have some others that will do green or emerging tech, but that's how I'd classify a boutique fund, where we've got a very specific mandate. We're very small, and we focus exclusively on very early stage.
And I guess that kind of moves into the role of the actual boutique fund. Like the role is to mentor. Like, where is it ideation to launch? Like, is that where you think the sweet spot is for a boutique fund? Is it early stage? Like, is it kind of initial customers? Yeah, so
we define it as early stage, but it's probably more around making the right fit. So, is our capital the right fit for that company at the time? I'll tell you a little bit about how it started, because I think that might help understand the role, because we definitely didn't come up with something in a boardroom. It was definitely in market. There was definitely a big, what we saw as a big gap in the New Zealand market. So, there are a lot of very good mainstream traditional VCs in the country, and however, what we found was a lot of the traditional VCs, they didn't really understand the nuances of finance. So how a bank's balance sheet works, how insurance companies make money, how the payment networks, generate capital. On the flip side of that, the regulation, is also quite tough. Finance regulation is really unique in New Zealand. Well, not just unique in New Zealand, it's unique in every market. So the traditional VC's model of, find the person tinkering in their garage, right, put some money in, prove product market fit here in New Zealand, scale globally, 100x, walk away. That's the
happy path.
Pardon? Happy path. Now with fintech, it can be a little bit different. So fintech, scaling globally, it can be tough because every market has its own regulations and different nuances there. But also, depending on the type of vertical or the micro vertical in finance, you probably don't need to scale globally. This is $1 trillion industry just in New Zealand if you take all of finance, but also you can be quite strategic. It's not necessarily about just going to Australia. It could be about going to Asia or Singapore. It could be about going to the UK or America. Or, to be fair, there are finance companies within New Zealand that have the wherewithal to create exits. So what we found was that a lot of, with the emergence of CDR, with the emergence of some open banking, the Deposit Takers Act, a lot of finance regulations are about to be changing. That's going to really explode innovation. So Marty and I saw this sort of coming, and we were sort of yelling out to anyone who will listen, hey, New Zealand needs a fintech fund, New Zealand needs a fintech focused fund. And what ended up happening was we realised no one was really hearing us, and we actually sat down one day and said, oh, shit, it might just have to be us. And so what we realised is once a fintech had shown product market fit, once a fintech had hit $1 million ARR, the bigger VC funds in New Zealand and Australia would invest in them, no problem. Right. Henry, Sharesies, Xero, no problem. But having the faith or having the confidence, pre-revenue, hey, I've got an idea, or, I'm halfway to building my MVP. A lot of the traditional VC market in New Zealand probably didn't really understand with confidence around how that could play out and how big that could be. And so we realised there was a huge gap, especially with, as I say, those regulation changes coming. So, 18 months ago, actually, so March 2024, Marty and I put together the New Zealand Fintech Fund. We went to Icehouse Ventures because we were both members there and said, look, we don't want you to hear about it in the market. We think this is underserved. We're solely focused on early stage. And they admit, we don't understand it. We understand it when it's got traction, but we don't understand it early. So they backed us. They're a partner of the fund. So together we've sort of gone in and made 9 investments. So what have we invested in? So it's typically, we don't do ideation. We're not an accelerator program. We might see people pre-product or just with an idea. We might give them feedback or keep in touch with them. But the things that we've invested in have either been pre-product or product is being built. A lot of pre-revenue. Right up, the latest thing we invested in was a merge about a year ago, but we had eyes on that, and we're quite closely related to it.
And that's a bit later.
Yeah, that was a bit later. So, and our check sizes are anywhere between 50 to 300k.
Yeah, cool. And I guess some of the selling point of your fund and working with you guys is the access to the advisory side and kind of I guess trying to reduce that cone, what we call in our business the cone of uncertainty.
Yeah.
Can you talk about how that kind of plays out? Because I think that advisory is a misunderstood piece in the play, because I think it's sometimes quite untangible, and a very interesting space in the startup ecosystem, because it's heavily used, but has varied outcomes, right?
Yeah, totally. So we're very active, and so we play an advisory role. We have an advisory part to our business as well. And, coming back, like, finance can be tricky, if you're going into wealth, if you're going into payments, if you're going into banking, if you're going into, taking deposits, loans, lending, frauds and scams, every little bit has its nuance. And there's two things that we talk about a lot. So finance is quite unique because of the economics, like how you can make money. And it's not very well known around how finance companies make money. And they make a lot of money. Like banks, make 55% net profits, and, it's in the billions. So I think, so that's one. The other one is regulation, with all of the regulatory bodies, all of the laws that you've got to follow about whether or not you're taking retail capital or whether or not, you're holding on to deposited funds, whether or not you're doing payments. Like, there are a whole lot of rules and a lot of people don't understand them. We get them, we know them really, really intimately. So what a lot of other funds might be a little bit scared or nervous about, we actually get quite excited because we really understand how to navigate all that. So to us, it wasn't just about capital, and we definitely didn't want to be lazy capital, sort of spray and walk away. So we call it the 3 C's. So we do capital, we do connection, and we do capability. So we, with the team, we've got very specific skill sets. There's 4 of us in the team, and with decades of experience and knowledge in New Zealand, being able to connect people to a second tier bank, being able to connect to business relationships, being able to connect to the top 3 finance lawyers in the country, how to lobby, with the government, with the Deposit Takers Act or open banking. We provide quite a lot of that connection, and we can. And we go to a lot of those meetings, and we are quite active, but also, part of that capability where we have internal legal resource, we have internal product resource. If they're super early, they can work out in the office, for a period of time. And, we have UX front-end design, with access to back-end design if people need. So, that's how it plays out in an advisory role. And, if it's super early, we don't charge. If it's super late and they can afford it, we'll give them a very friendly rate. But it's definitely a passion. This is definitely not a major revenue generating enterprise at this stage.
As in the Fintech Fund itself?
So Unity. So how funds generate capital? Every fund will do it differently, but prototypical, straight down the barrel, they call it 2 and 20. So 2% management fee. So for us, we've raised $2.5 million. That's $45,000 a year.
Doesn't pay full salaries.
No, that does not. Doesn't pay for 4 heads or rent, or probably your Microsoft software. So. And that's only for 5 years. So, after 5 years, there's no more management fees. The 20% is the carry or the commission. Yep. So we have an 8% hurdle. So that means that we will not take a commission until we've cleared an 8% rate of return per annum for our investors. Yep. So our investors get their first 8% without a commission rate. And then so really we're doing this we've taken a responsibility for the first fund to go, look, we're going to sing for our supper. We're going to be super active. We're going to try and tilt the odds into the favour of the companies that we've invested in. So they can generate a big return, but it's a 5-10 year play. Really, when Marty and I got together to do this, it was really about, we've got to commit to this, and we've got to, if we don't get paid for it, are we doing the...
you have to be in the market for 10 years, really. Whenever you commit with a fund, especially a private equity fund or a venture fund,
yes,
you're committing for 10 years, basically, because you have to rally the whole book through, you have to risk manage it through, you have to get your liquidity out. It's a very long process, and I think that's it's a bit of a misunderstood process. And then, obviously, you are also raising your own capital.
That's right.
And pitching to say, hey, back us.
Yeah.
I guess the incentive is slightly different in the end around, you're looking at how do you help your companies get exits.
Yep.
You know, whereas you're not really thinking about an exit when you're, I think, a VC fund.
Sure.
VC funds aren't thinking about exits from what I can see. They're thinking about how do I create more funds, how do I build my book, and how do I then allocate that capital. I think is kind of and I would almost say that especially boutique venture funds or you know very prominent people on the angel list, right, that are doing this, I would say, and they had, what do they call them? They called them something, right? There was like a name for these VCs that popped up in 2021, 2022 that were all on like angel lists and stuff.
Oh, really? I'm unaware of it.
I can't remember what it was called. It was a bit of a thing in America where like these, entrepreneurs and operators basically got LP money. Like solo VCs.
Oh, really?
I can't remember what they called it. Yeah, it was a whole thing. It was a whole movement.
I guarantee you're going to click either at the end of the podcast or probably about half an hour after the pod finishes.
Yeah, for sure. But I would say it's a lifestyle business in a sense, right? You're doing it for the passion, you're doing it because you want to see change, and you're not really doing it because you're expecting a singular exit event.
No, we're definitely, I think using traditional venture wisdom, you make 10 investments,
one of them's going to do great.
One of them's going to do great, 7 of them are going to fail, and 2 of them hopefully will break even. We're definitely not playing that game. We've made 9. We've seen 136 companies in fintech in New Zealand. We've made 9 investments.
That's actually quite high.
It's a lot.
That's actually a high conversion rate from companies seen to invested, right?
Yeah,
it's like over 5%. That's quite high.
Yeah, I think we're sitting at about 8%. 8% that we'll invest in. So there's 2 things there, right? So one, we've got 9 companies. For the most part, we're helpful for all of them. We'll react to anything they need. We're super active on probably half a dozen. 6 of them will have had a lift in valuation by Christmas.
Yeah.
So and we've followed on in 5 of them, which is a ridiculously high conversion rate as well.
Okay.
But it's interesting. I mean, whether or not you want to talk about it now or a little bit later, but what that also means is that there's 127 that we've had to say no to. And I think that's something that we have to get a lot better at saying no. Because we practice it so much more than we do about how we say yes. And that's quite unique. And we've probably said no to a number of businesses that are going to be really successful.
Oh yeah, for sure. Without a doubt.
Pardon?
Without a doubt, right? That's the way it works.
Yeah, and it was just, timing, or it's probably also not a thing around whether or not we don't see that company as being valuable. It's just the promise we've made to our investors as to where we're going to deploy their capital. Because it isn't just, well, for us at least, it's not just around, hey, give us $1 and we're going to turn it into 3.
Yeah.
It is very much, we had these really high areas of conviction in finance. We were trying to be, insofar as proving well, trying to be ahead of the market. We knew that there was some regulation changes coming and that would blow it up. And what we were really hoping for was that in 10 years' time, people were going, well, of course, you were perfectly timed.
Yeah, right.
We were probably a year early, but I'd rather be early than late.
Yeah, I mean, I think that you have the benefit of Henry and Sharesies coming through, I think, and also Kernel as well.
Yep.
Who have had great growth. And then there's a whole bunch of other coming along with basically government posture being in a very specific way that is beneficial to fintech and innovation in finance. It is an interesting time for fintech, especially in New Zealand and Australia.
Yep.
There's over $1 trillion in market cap, probably gone down a bit now, but in banks in Australia.
Yeah, it's insane, isn't it?
So if you just take 1% of that market share, you're getting $10 billion, basically.
Yep.
So that's kind of, so when someone goes to, I'm going to just take 1% of what the Australian banks have, and I'm creating $10 billion of value.
Yep.
Right, so that's interesting. So yeah, you guys are raising capital. So I guess, would you like that 8% rate to go down? So you said you want to get better at saying no. Does that mean that actually you would like to see more companies than actually proportionately invest in less, ultimately? Is 8% too high? Would you refine it?
Oh, that's a great question. It's not something that we've looked at and said, oh, that's too high, we need to bring that down. I think we never wrote it down, but I think we always thought that we would be investing about 1 in 10, so a little bit higher.
Yeah.
There's two sides of VC, right? So there's the raise the capital.
Yep.
So you've got capital to invest, and then there's deal flow. So, where are the deals coming from? And there's a few things, are we seeing the right people? Are we attractive enough to the startup market that the fintechs that are starting out, that they want our capital as well? I think one of the assumptions, was would there be enough companies to look at?
Yep.
And that was a fair question from investors at the time, is there enough deals to be made? Are you going to be able to see enough companies that you can, that you're not throwing good capital at average business, was a concern. I will say that 136 in 15 months was very high. It was a lot higher than we were expecting. I think there was a couple of things there. One was there was probably some latent demand, so if we had launched a year earlier, we still probably may have only seen 150, for example.
Right.
Do you know what I mean?
Yeah,
so I think there were a lot of people that had been, especially around that 2022 went through the roof. 23, the capital markets. 24, the capital markets were really dry. It was really hard to raise capital around then. And so I think there were quite a few fintechs that were holding on. They'd done the rounds. Traditional VCs probably couldn't. They were too early for them, or probably couldn't understand the finance or the regulatory environments, and so when we came about, we probably got flocked. We probably there was a bit of a small flood come to us,
which was good by the name.
It was.
Helped.
Yeah, it definitely helped.
And the time helped. And then you had the accelerator from Creative HQ, which came about, and you guys were able to get involved in.
Yeah, so we were. So that's a really good one. So Creative HQ did an amazing job. You were a part of that, and so we partnered with Creative HQ. We talked a little bit, they wanted us to put a whole bunch of capital up and turn it into a bit of a competition. We were really empathetic to that cause, but we've got a responsibility to the investors' money, and we didn't want to turn it into a competition. We committed to going, look, we will put money in for the right company, but we've got to be responsible for our investors. But we were really active with Creative HQ in terms of. You would have seen Jamie and Kate there, 2 or 3 times down in Wellington. I think out of the 18 or 20 companies, we had seen 16 of them, or maybe 14 of them. So, we provide, hey, look, these are the companies we see that we like, but for, whatever reason, we didn't have enough capital at the time, or it wasn't fitting our mandate, but we really like these companies. We can see them being really successful. So we passed that all over to Creative HQ. And that, again, is a part of, there was no financial gain for us by being involved, but that's the right thing to do for the community.
And brand building in the early stages of your boutique fund, right?
Yeah, it was interesting. That wasn't part of the plan, but I think it landed really
helpful,
well.
Right?
Yeah, totally.
I think that timing, again, was quite nice.
Yeah.
Right? You had just really great timing of launching, doing a lot of pre-work, seeing a lot of companies, then able to pass that on. That's value you're passing on to Creative HQ.
Yep.
So that's it's helpful because you guys have basically just done a deep dive sprint on everything going on in NZ Fintech, right?
Yep.
I guess I think where LPs, if I was putting my LP hat on and thinking about investing in NZ Fintech Fund, I would also be like, I wonder if you guys should almost do a fintech sidecar fund that is actually investing not in New Zealand but in fintech.
Yep. Yeah,
because because that's like, to me, then that kind of objection you guys currently have around, well, fintech in New Zealand is small. Why is there a dedicated fund to it?
Yep.
Oh, damn it, our notes fell off.
Oh, that's right.
So that's kind of, would you guys ever do that?
I don't know, and let me tell you why. I think a lot of the other markets that we know quite intimately are in a very different stage. They're a lot more mature than we are. Right. So if you think about, fintech and all of the micro verticals within fintech, and a lot around what's happened with regulation that's enabled that innovation. Like open banking in the UK and Europe is 10 years old. Yeah. Like they launched APIs and open banking regulations in 2016.
Yeah.
America and neobanking in UK, the Monzos, the Starlings, these guys are all making significant amount of profit and shareholder returns as dividends. America with Chime, a lot of people have gone and bought, all the savings and loan, local banks and turning them digital all through South America. Australia had an RADI, which is effectively like a restricted banking license. They did this in 2018, where anyone could get a restricted banking license, but you couldn't have more than 2,000 customers and $2 million in deposits. But it allowed you to actually have customers take deposits.
Concept.
Yeah, so you could prove you could build your product. The issue, you had a license for a restricted, like a learner's license for 2 years, but then you had to go from 2 million in balance sheet capital to
a lot.
Half of, and so I think there was about 8 or 9 neos, if you like, that sort of came out.
Seemed like it hasn't been a success in Australia, the neobank space.
No, you're right. And my personal hot take on that is that the intent by the regulator was correct, the execution was off. So the training wheels were too low, but there was no step to graduation. It was straight from
learners to full.
Learners to
full.
Have been
restricted kind of.
And you'll notice like Zinja pivoted and did like crypto trading and 86400 got bought out by one of the majors. Up. So the two that really survived were Up, and they were banked by South Adelaide or Bendigo. They ended up buying it for, I think it was like 350 million, buying the other half of 350 million. So the people that started Up did very well. And then the other one, Judo, which was a small business bank. Like they just looked after small businesses, and you can see, I think they publish their annual earnings every year, and they're, whatever it is, 7 years later, generating a lot of shareholder return. So while I agree, and I mean, in the Asian markets, I think money markets and the Western worlds, like I akin it to music, where you've gone from vinyl to cassette tape, to MP3 players, to streaming. In India and China, they went straight from vinyl straight to streaming.
Right.
So all the QR codes and the WeChats and all the rest of it. So we know a lot about the international markets and fintech, but New Zealand is lagging so far behind. So one thing we know is that a neobank will have 20% market share, or all of the neobanks in any different market will have 20% market share once those regulations change, within 5 years of those regulations changing, if it's analogous to the other markets. We know that open banking,
So neobanking is currently 20% of the UK market.
Yep. Yeah, so you take those banks that were created pre-2020, they will have 20% of the customers, 20% of the balance sheet will be with a neobank. Yep.
That's crazy number.
It's huge. Yep. It might be more now.
Wow, I'm surprised, to be honest. Wow. That's a lot more than I thought when I work in fintech.
Yeah, and now it might not be so in New Zealand,
Is that number of users mustn't be AUM, mustn't be assets, right? Because there's probably a tilt towards like traditional organisations having bigger customers.
Bang on. And 1% of volume, an HSBC high wealth will have,
exactly. Okay. So from per capita almost perspective, like a user base perspective.
Definitely,
is that what you're talking about? Okay.
But also understand that there's probably 120%. Like, if you, even in New Zealand, you look like Westpac will say they've got 20%, so will ASB,
right.
ANZ will say they've got 35%. You add it all up, all of a sudden there's 120% of the market. But I don't know about you, but I've got 3 bank accounts, so, who... And, this used to frustrate me when I worked at, it's like, we own the customer. It's like, well, like, I bank with, a yellow, a blue and a red.
Yeah.
Who owns me? Like, but again, I think, within 5 years, there's a volume there, but it's also how are you, like, from a banking point of view or a neo-banking point of view. And I think the Monzos and the Starlings, Monzos and the Starlings, they led the way.
Yeah.
Are you all good?
No, we're good. I'm just making sure that we're good from a battery perspective.
So, okay. A Monzo and a Starling, so back in the day, they sort of led the way, and they did, Monzo especially, they did very well at getting customers on board. I mean, I don't know if you remember, but they had this Coral card in 2017, and that just... It was cool to have this card.
Yeah, right.
However, they found it really, really hard to generate revenue because they couldn't incentivize deposits.
Yeah.
And it wasn't until they started getting the salaries popping into the Monzo accounts. So it's very, very easy to drive volume. It's very, very easy to get people on board. It's a bit harder to go deeper and richer, but that playbook's 10 years old. So, there's 3 in New Zealand currently that have aspirations of being a neobank. We've invested in 2 of them. And, it's not just around, like, have the flash card, get the customer base, but what are you doing about actually, working on your balance sheet? Like, how are you incentivizing having people put deposits into your account?
Yeah.
That you are, that, like, when when you Apple Pay, who's the primary card? Where are people's salaries going? If you're a business bank, or have aspirations of being a business bank, whose bank account number's on your invoice,
right?
Because if you can build your balance sheet, if you can build your deposits, that once you're licensed, you can trade those deposits for loans. And that's how banking makes money, right? Like, they pay for deposits, that's their cost of goods, and then their revenue is the lending that they do on that primarily.
Right.
I'm making it real
sure.
simple. No, so we've journeyed off, but like, you look at any mature neobank market, 20% bank with neos, but there's probably
have access to neos, but maybe that penetration of, like, that income or the savings, etc., will take longer. There's a longer tail to that AUM adoption, but in terms of people trying, playing, exploring,
getting confident.
But I think that's it's a confidence thing, right? Because there's, like, a bunch of products in market from fintechs like us and others in market right now that are fundamentally better than the incumbents.
100%.
And a lot of people complain about the 4 banks that are some of the most profitable banks in the world. But they still don't have the confidence yet to actually vote with their dollars. And voting with your dollars is ultimately, you have to take the action that is encouraging the change. So if you complain about banks, but you only adopt and use banks with 99.9% of your capital, then the industry will most likely not change. It's a flywheel, isn't it? And to give, some leeway to New Zealand. I mean, none of these neos can call themselves banks yet. They're talking about, changing the Deposit Taking Act, which will help. But a lot of these, so hopefully what people are doing is they're trialing them, or what they're doing is they're actually now going, what's the type of experience that I want? What kind of bank do I want to be with? And, if you look at, like, the fundamentals of a bank, the high engaging, the high volume interactions that you personally have with your bank are really the loss leading stuff, the everyday banking, transactional accounts, checking your app, where did that money go? Hey, what's this merchant code? I don't get it. There's no real money in that, but
I think if you've joined in, one of these neos, you'll actually look like enriched data, like you jump onto a merge, it's like, why is my balance this? You go in and, it's got logos, not just the merchant 7, 8, 9, 10, 11, it's, the warehouse, and you click on it, and then there's a Google Map API showing you where that warehouse was, where you spent it. Which card, it's got a place for taking receipts if you want to take receipts. So that experience is definitely changing and hopefully building trust, or hopefully what it's doing is the experience of banking can be so much better, but they're not regulated yet to be able to generate the income, to really get that flywheel going. But this is where it starts.
Yep.
And no neobank in the world sort of really shot to stardom within 5 years. Like it takes a long time.
Yeah.
Confident, it's interesting, right? Because it's not so much it's confidence, but I think it's trust.
Yeah.
And I think trust changes generationally. So a baby boomer would trust government endorsement. It would trust seeing, brick and mortar on the store, everywhere. They'll trust tradition. They'll trust decades of time and market. Whereas you look at millennials, or even like Gen Z, they don't trust the government, but they trust social endorsement. They trust 5-star ratings.
Yep.
What do their friends recommend? They don't trust brick and mortar. They trust digital experiences.
Yep.
Do you make me think when I'm in your app? They trust. They trust brand integrity. Are you consistent and congruent everywhere with your brand? So I do think that trust is just, totally. we're probably about 10 or 15 years away from Gen Zs being
comfortable.
Well,
not comfortable. They're already comfortable, but
having the money to
adoption, etc.
and to really swing the AUM.
Yeah. So I guess from your experience, what do you think what do you think, I guess, that the general playbook is to actually kind of survive when you are capital constrained in a space where the revenue streams, they are slow and linear early, and then they explode as you get scale?
Yeah.
How do you survive in a capital restrained? Because you've got two types of capital. You've got capital that is paying for ops, and then you ultimately have capital that is on your balance sheet and allowing you to deliver more revenue or better margins.
Yeah, good question. It's probably the same thing. It's priority. You can't do everything, so you got to choose those things. I think you got to take your customers on a journey. Depending on your vision. If you've got this thing around, hey, we want to. If we're talking about neobanking or wealth or even lending and loans, you've really got to capture the hearts and minds of the. You've got to have a vision, and then how are you sharing that vision, either vocally through marketing or through your actual product. So, a really good example, another one of the in the portfolio is a company called Blocks. I don't know if you've heard of Blocks. They're really wanting to turn the mortgage market on its head. So, 1% deposit, anywhere from 2%, and then just pay a similar amount as rent, and you're not borrowing a mortgage or borrowing capital, you're borrowing equity. So effectively, for a 1% deposit, anywhere from sort of 2 to 3% a year in rents, you can own your own home in the Auckland or New Zealand property market. And so that vision's quite big, and they've exploded to a backlog of 4,500 customers ready to go to buy a home. But now they've got to deal with the
funding side, the balance sheet side, ultimately.
Yeah, and so Chris Smith, Cliff Curtis, they went over to two of the founders went over to Web Summit last week in Lisbon, presenting to big institutional people that want to start making mortgage profit, but they're not making as much NIM or net interest margin as, say, a bank, but it's a significant amount. It's really purpose-led, and they've now got eyes on fulfilling those $4.5 billion worth of property that will change. And so, I think in their for lack of a better term, they're bootstrapping. They're putting a lot of this together. And so I think it's around not being able, not wanting to go out and go, right, we want to be huge within 4 months. I think there's an element of, right, how do we prove our product market fit? How do we experiment and test, showcase our vision? How can we show with 100 customers that there is viability here? How do you listen to your customer base to prioritize your backlog?
Yeah.
How can you dislocate the business model? So, sorry, I use dislocate. This is a thing we use quite a lot, especially in banking, because a lot of people talk about disrupting industries, and disrupting is a military tactical verb, where the military will go where it's the use or the removal of friction to change your enemy's course. And so, disruption, when Uber and Airbnb were really big, what they did was they just removed friction and people flocked. So that's actually the history behind the word disruption. The military have got another tactical verb called dislocation. And so if you think about banking or mortgages or anything like that, it's a tug of war, 3.89%, 3.79%, 3.75%. It's just a tug of war race to the bottom. Dislocation in military would be if you're in a tug of war, let go of the rope. And your opposition will fall over. So this is the challenge that we, or the thinking we would provide to the fintechs, whether we have got an official relationship with them or not, is around how can you use business modelling, or how can you use your value proposition to dislocate the market. So if you were going to do a savings account, and the market saying you should be doing 2% or 2.25% based on OCR, well, fucking throw away the percentage, throw away the word interest. That's all bank terminology. Humans we don't want to use that language. We've got to translate and understand how banks work so we can get it, for the majority of people. So how can you use, we're going to do a reverse fee, or we're going to pay you the subscription, so I think or how can you, if a different industry got into banking or got into finance, how would they model it? What would Apple do? How would Netflix do banking? And just taking that frame of thought, because I think if your product, if your business gives value to your customers, you can ask for value back.
Yeah.
But how you ask and what you do, you've got a free, as long as it's legal, you've got a free fucking rein on how you do that. And I think, especially in banking or especially in finance, it's easy to fall into groupthink.
Yeah. Interesting. Yeah, no, that's
a little bit of a rant.
Yeah. No, that makes sense. I mean, there's a lot of nuance to go into when you're thinking about, okay, well, how does someone, how do you actually survive long enough to build up and kind of keep going? So I think it makes sense. Yeah. It obviously just is. There are a lot of different things coming at you in fintech because there are dynamics of the business. There's business relationships that matter a lot more than, for a fintech, than your average SaaS company, because your average SaaS company is not actually having any questions or conversations really with the bank when they actually just consume general services. Totally. Whereas obviously there's a whole different dynamic there, and an interesting conflict of interest for the bank, right? Because the banks are actually there and have the keys to enable the fintechs to work. And there's an interesting conflict of interest and power dynamic there that is definitely interesting, and something that I think from a government and a policy perspective, there's a lot of incentives to change. So it'll be really interesting to see what happens over the next couple of years.
Yeah.
Well, thanks for coming on to talk about the day in the life of a boutique VC fund. I think we've covered a broad topic in fintech, but I think it's really interesting where we're able to go with it. So thank you so much, Mike.
Oh, my pleasure.
Yeah.
Thank you very much.